Shake my hand one more time. Welcome everybody to another video, 365 Trading Academy. I want you to stick around for this video. I'm going to be discussing all the things that are going to happen in May. May is probably the craziest month of the year 2022. All the things that are going to impact the financial markets, stock markets. I'm going to be looking at the NASDAQ 100 and the QQQEFT that actually tracks the NASDAQ 100. I'm going to talk to you guys about the Fed rate meeting happening in about 24 hours. What I think is going to happen and explain the logic behind the potential priced in rug pull that we're currently seeing. And then I'm going to give you my final thoughts about what I think, a trader should be doing, a trader should be looking into, considering all the crazy things that are about to go on, man. May is going to be absolutely insane in the markets. All right, so a couple of things just to bring up, and you know me, if you've been through my videos, this is how I want to start them. It's important. So one more time, if you've done it before, let's do it together again. Every day, say it out loud. Vibrational frequencies to program your subconscious mind. Every day, in every way, I'm getting better and better as a trader. Every day, in every way, I'm getting better and better as a trader. It doesn't matter how. Watching videos, following rules, trading more, back testing, doing the course, understanding basic stuff about supply and demand. Every day, in every way, I'm getting better and better as a trader. Because of that, I'm so happy and grateful that money comes to me in increasing frequent quantities on a continuous basis. I believe this is true because it has already happened. I am grateful and thankful for everything in my life. Money is forever circulating freely in my life, and there is always a divine surplus. One day we'll get to the full affirmation card that I use, but this is a very good basic stuff to kind of like get your day going right. So I am quite not worried. I'm thrilled about what's about to happen in the market space. I believe there's going to be a lot of room for learning, but maybe just so that we are all aware, right? The month of May, today is the 3rd of May, is one of the most impactful, most filled months I think we're going to have in the year. Look at it this way. Every time there's been an FOMC meeting, and I'm talking all the way back to November 2021, NFP would have already happened, CPI would have most likely already happened, would have had a lot of good data, ADP monthly data, wage data, a lot of good data in the market to help us almost predict, right, what Powell and what the FOMC is going to vote and say. Because if we understand how they use that data, we understand the FOMC's agenda, we can then almost think like them, which is what we love to do at 365 Trading Academy, right? Teach people how to understand and conceptualize smart money concepts with the reality of order flows, right, where institutions are buying and selling. But this particular meeting is historically, shockingly different, right? There are a couple of important dates that I want you to keep in mind that you absolutely have to write down. Number one. Number two, you absolutely need to go to Forex Factory and check that out, right? And I'll probably put a tab open for you there very soon. And just keep track of these events and also understand how they're going to move, right? So between today, the 3rd of May, all the way to the 11th of May, markets are going to look like this. There is going to be some good times and there are going to be some bad times, good times and bad times. And it's just going to be a whole, it's going to look like a 2-year-old is drawing on the charts, basically. And I'll tell you why. The first thing you need to take note of is if you watch this video on time, right, today we've got the JILTS jobs report. Very important. Today we've got the JILTS job report. Now, the JILTS job report is a classic thing to kind of like look out for. If the job numbers plummet, and I'll take you now to Forex Factory, but if we get a negative, reading at 4 p.m. South African time today, all right, what's going to happen is markets are going to take this as a recession indicator. One day, I don't want to put a date to it because I always get into trouble, right? When my module 3 and 4 go live very soon, I promise, right, I will create a free free, completely free fundamentals module that everyone can have access to and have a look at. But it's not the most important thing in your trading, but it's nice to know these things. It's nice to understand the impact, right, of these things. Now, if it comes out at negative today at 4 p.m. South African SAT time, this is going to be a recession indicator. Let me just quickly show it to you. Let me just quickly share my screen, screen 1, 2, screen 3 there. Right, so there we go. Look at this. Right, so in front of you, you should see Forex Factory, right? The kind of stuff I want to get into today. Today at 4 p.m., right, we've got the jobs just report, right? And the forecast is 11.19 million, right? And this is literally coming down. So there's already a little bit of contraction in Q1, contraction. The economy did shrink just a little bit, but we'll hear what Powell has to say tomorrow. All right, so 11.9. Now, I'm saying if this comes out as a negative, if we miss this, going to have a problem, right? Because this actually calculates the number of jobs opening during a reported month, like excluding, very important, excluding the farming industry, right? So if this takes a hit, right, then your dollar might slow down just a little bit, and it would serve as the first recession indicator, right? There have been many recession indicators. So really, I mean, to put it in a semantically correct sentence, it would just reaffirm, recession worries in the markets, right? And this is going to happen before Powell speaks tomorrow, right? This is happening today. All right. The next thing that I really need you to kind of like take note of and to write down somewhere and be organized as a trader is that number one, 365 Trading Academy channel, this YouTube channel that I know you're going to like the video, this video and all the other videos, but please subscribe and get notified because tomorrow we're going live. When the Fed goes live, I'll go live. So I'll stream the whole thing on the channel. And if you followed me last time when I did that, I'll pause here and there every 30 seconds or so just to explain, some of the words they're using or what this actually means in the market. And we'll be looking at the charts as Powell is talking. I want you to see, why a lot of people love trading during the news and why I completely advise against it, right? Let markets play out so we can see reaction. The recovery buys from the 14th and 15th of March were based off and fueled by what Powell said on the 16th of March, right? So no one knows. Well, I'll tell you what I think about the whole thing, towards the end of this video. But we could get something like that, and we could also get the complete opposite. So tomorrow, second big day to kind of like keep track of. Tomorrow is the 4th of May, right? And Fed is expected to raise interest rates, right? And let's just be clear. The last time we spoke about this, Powell raised rates by 0.25 basis point, right? Which meant interest rates were now sitting at about 0.50 basis point. At that time, it was obvious. It had become so common. Even most retail traders knew 0.25 was coming in. Markets priced that in. We saw the dollar not even rally based on that because the rally had already happened, number one. Number two, the dollar had made contact. Very important, right? Let's give these things context. The dollar had made contact to a supply. Right, so I'm gonna quickly track this out for you on the charts because you have to see before the news event goes. Your question is where's the movement going to be? How are markets going to move? So in front of you should be the dollar DXY chart. Just don't mind my annotations here. Right, I'm just gonna drag this chart a little bit down, and then we're gonna hit it to. I'm pretty sure it was the 16th of March. I can't remember now. 16th of March, maybe. There's somewhere down here. Right. There we go. Right. So believe you me, on our left there was a very big supply, a governing supply, something, yada. And then Powell spoke, and all of a sudden, right, we got interest rate hikes, but the dollar still came down. Remember, when interest rate goes up, it is generally good for a currency. That currency should strengthen, but we actually got the opposite, right? So the dollar started to rally, and what Powell spent the last 30 minutes of that meeting, which is why you should watch these meetings live, read the statements, or sit through my channel as I cover them for you, is he kept saying things like, jobs are good, economy is stable, we've got inflation under control, we're going to drop it all the way down to 4%. And so even though he increased the rate, right, he massaged the economy with his words. And so NASDAQ, Dow, S&P 500 rallied for about 2 weeks, right? And we had a slight consolidation phase right here with the dollar. Beautiful consolidation phase, a beautiful time to buy this thing, right? And I didn't, like, I had short buys, but I wish I'd gotten on some good swings, right? As soon as markets consolidate like that, I hate such setups. I normally want to take the one below, and it actually never happened, right? But this was a perfect buying opportunity in the dollar if you had that long-term perspective, which I had. I just don't know, why I decided to close, my profits, long story short, dollar rallied right off that. But the first time the interest rates were actually announced, the dollar actually fell for a couple of days, right? So we had almost like a reverse effect, but it was understandable. The structure was at a supply, and ever since then, markets have moved out of their way to breaking 2 monthly supplies. That is significant. And now the dollar is at a pause, a new small window of consolidation. That's called the PCP pattern in front of you there on the daily time frame, a potential continuation pattern. If you're supplying demand trader, you know that there's a campaign here for some buy orders or for a potential market reversal, which I don't really believe in. I think the dollar long term is still going to rally, right? But we can talk about the jilts and bolts about that, right? So 2 big things: jobs data today, and then the next thing that we were covering is the fact that markets are going to have to literally deal with the fact that the Fed tomorrow is supposed to come and give us some type of adjusted 50 basis point. Now, the markets have obviously speculated and not agreed on, but everyone believes we're going to get 50 basis point. The Fed has been clear about that in the last several public outings, public meetings, 50 basis point, which is different from Powell's original 0.25, different from Powell's original. We're going to follow the 2004 module, which is the most important part of this video. I'm going to explain why this rug pull is coming. I'm going to explain why Powell is changing, shifting, goalposts. And if you don't understand this, you might get yourself caught in the wrong side of trade, right? So while we're focused on that, I have to bring to your attention, though, weirdly enough, a lot of people in the market still feel like it's not enough. And I'm talking institutions. I'm talking about a lot of people are speculating that by the end of the day today, we might even get, tomorrow, sorry, a 0.75 basis point, right? Which would be wildly, it's a bit aggressive, but if you look at the Fed, monitoring tool rate, a lot of people believe that we need a whole lot more, or rather believe that the FOMC might come out a whole lot more aggressive than we think. And that could be a very good explanation as to why markets have been tanking of late, right? So have a look at this, 4th of May, check this out. 99.3% believe what we are going to get in the next 24 hours, literally 1 day from now, in the FOMC meeting, we're going to get about a 0.75 to a full basis point, hike, which is absolutely, incredibly aggressive if that's what we get. But there's a reason for that, and it explains a lot of the fear and panic we're seeing in the stocks. Remember, when interest rates go up, stocks tend to do the negative. Stocks are also coupled with crypto, so crypto tends to do the negative too. They tend to go down, right? What we're seeing, guys, is what we call monetary policy tightening. We're tightening the budget. We are slowing down on printing money or stopping, QE altogether, and we're slowly starting to cool down the economy. They're trying to manage it, right? So market speculation right now is at 0.75 to a full point. I think Powell's going to give us 0.50, even though originally it says it's going to only do 0.25 across all these meetings, right? So there's this aggressive stance, right, that the Fed is kind of like, indicating to, and a lot of people are starting to, to pick up to that. And it's absolutely crucial that we understand why. Right now, the next big thing, to kind of like have at the back of your mind is May the 6th, right? This is pretty much a day number 3 now. May the 6th. These dates are important. May the 6th is our beautiful Friday, and you know what happens on Friday, right? On Friday, and maybe before May the 4th, right? So before the Fed speaks, which will be about 8 p.m. SAT time, I would encourage you to quickly glance through the ADP report that is going to drop tomorrow in the afternoon. ADP report is a precursor to non-farm payroll that I know for a fact a lot of retail traders don't even look at, right? It generally can be as accurate as it can be. Sometimes it throws the market completely off. It'll say there's a massive employment gain. When an NFP comes out, NFP will be like, nope, there was a decrease, right? But sometimes these reports do correlate. But in any case, I enjoy reading both because ADP gives us almost a good indication to what we can expect on Friday. So ADP report also coming out on the 4th. Don't forget that. Now, on the May the 6th, which is this coming Friday, this is all in this week, by the way, after the FOMC has spoken, right? So imagine Powell says the economy is good. He says the same thing he said on March the 16th. He says, I saw the mega caps earnings. I saw a little bit of worry, but overall we are confident. We're doing well with job numbers. We're doing this, we're doing that. And then NFP drops on Friday and NFP is a complete negative. Markets are going to freak out. So it's not a one-day event. I think that's the whole point of this video. There's going to be a lot of data that we're going to have to keep following and tracking because, again, markets are going to look like this for the next 10 days, up and down, up and down, up and down. And you absolutely need to be on the right side of price or just completely stay out, right, if you're not sure, right? But May the 6th, we're going to get the unemployment report. Now, again, if you're new to the channel, I always encourage you, don't get stuck on NFP numbers only, all right? That's important, but not really. Not in the context of the lost decade, recession, inflation, and potential market collapse, right? The NFP is important, but the other things that come out at the same time with NFP on the exact same tab are even more important. You want to look at the unemployment rate because remember, that is one of the biggest mandates of the Fed. All right, so let's quickly go to Forex Factory. Let's quickly go to Forex Factory so you see what I mean. Let's go to Forex Factory. I'm just quickly sharing my screen, screen 3. I have 9 now, I have that established. Right, there we go. Now, look at this. So this is Wednesday. There we go. By the way, right, ADP is saying a couple of things here. So we had 4 5K jobs last time. Remember, NFP the previous month was positive. Was it? I can't even remember. It doesn't matter. Now ADP is saying we should expect a contraction, right? Well, we're gonna get less. So their focus now is on 382 new jobs created in the previous month. All right, that's their focus. We need to come here at Goropos2 just to see how that's going to go, because this is going to affect the pre-rally before FOMC speaks tomorrow. All right, so those of you who love buying on steady NASDAQ because it's 4 p.m. and that's what your strategy tells you on the CNBC app, right? Be careful, right? That's what I'm saying. Be careful, right? At Goropos2 tomorrow, ADP drops. But I want you to focus here now on Friday. So when NFP drops here, NFP is saying, look, and look at this logic. I've done this so many times on this channel. In fact, the whole of last year and this year, we have not been wrong about any NFP forecast. Now, hopefully by Thursday, I can do a full video of what I think NFP will be like on Friday, like I normally do. But look at what NFP is saying. NFP is saying, look, man, if we can get 390,000 jobs plus, all right, then it's a good day in the market. It's a positive, strong dollar rally, blah, 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 right? From 431K. Now, if I look at the forecast for NFP, 390K, and I look at the forecast for ADP, 382K. We've got a range now. We've got a range to assess the market mood. It's not a big difference between 382 and 390. So if ADP is slightly positive tomorrow, you have, just wait for it. Don't have to pre-trade it. Just wait for it. If ADP comes out as 390, if ADP comes out as 395, if ADP comes out as 400, if they can find 400,000 new jobs, why wouldn't NFP be positive, right? Because NFP is already aiming for 390K, right? That's the logic. But we'll talk more about this on Thursday. What I really want to bring to your attention is when NFP drops, the first thing you need to focus on, apart from that, is the unemployment rate, right? They want to keep it at 3.5. And if you watch me Last time during the live, when I was doing the FOMC meeting, I showed you guys the economic summary projection report. And this is the magic number for the Fed. They want to keep inflation year on year at 3.5%. This is really, they have been working to get down to this number. It was at 4% unemployment. Then it dropped to 3.8, and then it dropped to 3.6. All good signs. And so now they want another win, and they want unemployment to drop to 3.5. This means we want as little as possible people in our country, America, right, unemployed. So 3.5% of the working population is a good number of unemployment. This is what they want. If this number, ladies and gentlemen, comes up higher, right, even if NFP is positive, markets could react negatively to this because sure, we created all these jobs, but unemployment is still going up, right? That's problem number one that you absolutely need to be focused on. Number two, still on this tab, this is I would say the biggest thing. Average hourly earnings. Remember, we've had inflation, we've had prices go up in America, in South Africa, in Zambia, in Kenya, all over the world because of a lot of things exacerbated by the war in Ukraine that saw oil costs go up, which meant fuel went up, or gas, whichever country you stay in, however you say it, and food prices went up. And so as those things were going up and countries were trying to come out of COVID and recover, create new jobs, those were jobs were requesting more in wages. So the higher inflation is, the higher cost of production of food is, the more people need more money to sustain themselves. If my rent and food go up, you need to pay me more so I can socially reproduce myself to come to work tomorrow. That's what it is. Any job you work at, it doesn't matter. It doesn't matter whether you're pro-capital or not. You're not paid for the work you do. That's a lie. It's a complete fallacy. I've written many academic papers around this, right? Remember, I'm a researcher more than any of this stuff. You are paid according to the cost and the perception of how much it takes to socially produce you to come to work tomorrow, right? So capital creates wages based on keeping it, you paying you as little as possible, which is just barely enough for you to show up to work tomorrow to make them money. That's just the truth. Now, if the wages, the hourly average earnings are hot, if they come hot, if they come 0.5, 0.6, if they go up, then we're going to have what is called a wage crisis spiral problem. Rising wages will allow for more price competition. Rising prices will then exacerbate the inflation crisis, and that whole conundrum continues for a very long time. And so what you want to see here, or what markets would like to see, you can see here, just before Powell spoke on March, we got 0, something. All of a sudden now we're jumping all the way back to 0.4. It's their market, they're allowed to manipulate it. You just need to understand the data. All right, so 0.5% and above means we're coming in hot. We're going to have those wage spiral problems, and it's something to be absolutely mindful of because the markets don't like that, right? And so you could get a positive NFP, but if employment is high, or a positive NFP and wages still went up, right, markets are going to react, and you're going to see the impact in risk sensitive markets, the Nasdaq, Bitcoin, equities, stocks, S&P, Dow, you know what I mean? Your sensitive markets are the ones that are going to show you the most amount of pain, right? So that's a couple of things to kind of like keep mindful of this particular week. And I'm going to break all this thing down. It's just that, like I said, it's absolutely important. For those of you taking notes, let me just quickly copy and paste my notes for you, right? And you can just kind of like pause this video and make sense of what we just said. This is everything I've just summarized for you right now. So these are big things. Now, you would think that's enough for the month of May, but there is a big thing, man. I don't even know how to quantify this. May the 9th, Victory Day. Can you believe it? Russia has declared there is going to be a victory day on May the 9th. What does this mean? Well, it means, technically speaking, they're going to carve up a piece of Ukraine, right? I've forgotten all those weird cities and all that stuff, right? They're going to carve up parts of Ukraine, declare them Russian territory, implement the Russian ruble in those new towns that are now part of Russia, right? And then march back to Russia and declare themselves the winner of the war. I can't even begin to tell you what I think that means for the markets. I don't know. I don't know. And I'll tell you why. Number one, this victory of Russia, the hated country in the world right now for invading Ukraine, declaring victory. What will markets price in? Is this good or bad? Is it bad because it's Russia and therefore Russia declaring victory is bad because everyone was rooting for the underdog, which is Ukraine, and it's a war and it's complicated and I'm not a war expert? Or is it good and markets are going to rally on the victory day because it means the war is coming to an end? Right? I don't know how markets are going to price that stuff in. I honestly don't know. It could be a bit of both, right? But the assumption is after this victory day on May the 9th, the assumption is we should start to see a de-escalation in war. And we know a lot of the pain from financial quarter Q1 was because of the war. So we should start to expect reasonably some type of rallies, right? Now that the war is gone, we should expect some reasonable rallies, right? So this could be a positive turn in the markets, right? But this one, folks, you are going to go figure out the sentiment of the day on the day. I mean, I'll cover it for you on the channel. Just subscribe. But right now, it's very difficult for me to wrap my head around how the markets are going to price this in. Is it a good thing that it is a good thing that the war is over? But is it good for Russia to declare a victory day, for Ukraine to use parts of its territory, for Russia to then impose the Russian ruble, which is removed from the SWIFT system? I don't know right now. I don't know. I'll spend the weekend trying to figure this out. And just in case you thought it was done, nope. On the 11th of May, which is the last thing I have for you, we're getting inflation reports. And inflation reports are absolutely crucial in this particular time. I've been teaching you guys about CPI and the CPI core. I've been teaching you guys about the PPI and the PPI core. These inflationary data are important. They always come out after NFPs drop. And this particular one is interesting because if you look carefully at the focus on Forex Factory, I won't take you there right now. You'll come back, to yourself, right? Month over month, they're like 0.2%. This means, guys, you have to think about this. This means that these people believe inflation has peaked. If you watch my previous video, right, my war room video, I'm going to put the link somewhere up here. But if you watch my previous war room video, the most recent one, in there I show you all the inflation graphs, and that the United States is about 8.9% inflation, and they believe it's peaked. Powell did say in March, when inflation gets to about 8.5 to 9% in June, I believe it will have peaked, and then we can start being aggressive from there, right? So it was going to go 0.25, 0.25, 0.25 until June. It's now 8.9% in April, May, right? So maybe that's why they believe it's peaked. I don't know, but just watch out for that, because I smell a rotten egg somewhere in there. All right, so please, guys, any of these things could jolt the markets up and down, up and down, up and down, up and down, and you're going to get a lot of conflicting signals in the market space. Now, how do I deal with these things? I'm going to sound like a broken record, but I'll tell you right now, I don't care about everything that I've just told you. I'm going to be looking at supply and demand levels, number one. But number two, not just that. I'm going to be looking at the logic of our trading strategy. The logic of our trading strategy must prevail. Buy low, sell high. Leroy, that is easier said than done. I agree. I absolutely agree. But supply and demand and smart money concepts and all these debates happening on social media, everybody has missed the point. I watched a video by a famous YouTube trader who was talking trash about, and that's fine. Maybe I'll do a response to that, we'll see. But the examples he kept using to justify his analysis of smart money concepts showed me that a lot of people still don't understand them. Supply and demand is a holistic concept of viewing the markets, full stop. Number one, but the way we use it at 365 is we use a rule-based approach. That means even though I can see a supply or a demand, there are many other things that need to happen. That's what the whole course is about. The course isn't telling you how to calculate pips no. My course breaks down every single rule you need to know to get a high probability setup. It's like a manual book. If you get a complicated bed or a piece of furniture, you get a manual and it's got pieces and instructions. This part goes here, this part goes here, this part goes here. That's how I want you to view my course. My course breaks everything down. Talking about my course, 4th of May. So after the FOMC speaks tomorrow night, that is the end of the 75% discount. Will have been extremely patient and waited and accommodated everybody who asked for an extension on the deadline. Instead of $400 US, it's $100 US for all 4 modules, right? So please act on that while it still lasts. But that's what we do. We are rule-based smart money concept traders. And in this particular season where all of this stuff is happening in front of you, I am going to be going back to the purest basics, right? Sell high, buy low, looking at very good high probability setups. Right now, let's quickly then move to the charts, because I know some of you are like, show us some charts, Leroy, show us some charts. And when we do that, I actually want to address, I'm going to take a picture of this for those of you who want a picture of it. And then I'm going to clear the whiteboard. I really want to address right now, currently, the state of the market just before FOMC comes through to kind of like mess it up, the state of the market. And this is important. I think it's absolutely important to almost kind of like explain and understand a couple of things that have happened. Why do we think that the FOMC has changed its mind from 0.25 basis point to giving us about 0.50 basis point, even though 99 point something of the speculators of the market believe we should actually get a 0.75% to all the way to a full point, right? Why do people believe that the FOMC is going to be more aggressive? Right, and we can tell the markets believe that because the markets all of a sudden have been falling, right? There's no doubt that we called the fact that the all-time highs were going to come to an end last year. We spoke about the fact that now that in November, we've got tapering coming across, that just be very careful. I covered all of this stuff, and believe you me, December, November last year, most of your risky assets had found the top. And by the time we opened in January, markets were falling. In February, markets were falling. And then there was a war, and then markets kept falling. And now we're in April, May, and markets have been falling. All right. So this is not like something that we are unaware of. The question then is, what is, aggressively shaping the markets, number one, but what is actually influencing the Fed? And real quick, because most of these things have been covered in the past, I want you to see it from the lens of Powell. I don't think Powell is always right. I think Powell has a job to do. Powell's job has nothing to do with your trading balance or investment portfolio balance. He doesn't care about your stock portfolio. Powell could not be bothered by markets reaching all-time highs. When markets keep going, if markets do this, by the way, for the Fed, every time making new highs, booms and booms and booms. This is actually for the Fed a scary scenario, because one day when this whole thing crashes, economies go bankrupt, companies shut down, unemployment goes sky high, and there are so many problems that they have to fix in the economy. What the Fed wants to see is a well evened out market that comes with its rise and falls and its healthy market corrections, even one of these a little bit. This is all the Fed wants to see in the stock market, not what we've had since 2020, which has been an incredible, lustful bull run. All right. Now, here's what I think is happening with the Fed. For those of you who are still paying attention to this part of the video, I sat through and really thought about the job if I was Powell. And I was looking at the first financial quarter up until May. So January until April, May, right? May just started. So the first 4 months of the year, which is a very good indicator of a lot of things. As Powell, I found myself staring at a couple of things. The fact that despite the bad news, guys, believe you me, there's been a lot of good news in the market. There's been a lot of good news, and it's very difficult to kind of like say that out loud. So I have to really go back to the data, but we've been getting a lot of good news in the market, and it just depends on how you look at it, number one, and how you understand it. For example, for the past CPIs, PPIs, job numbers have been skyrocketing, right, in the United States. I mean, we've been tracking NFP wins month after month. I mean, Powell was so proud of that in the last, FOMC meeting, right? So all these things have been absolutely good. But just to kind of like quickly, bring out a few, there's been definitely in the last report, number one, a completely flat expectation of consumer inflation. In fact, the JP Morgan, those of you who follow stock earnings report, reported that people are still spending money. There's Leroy on his YouTube channel, inflation. People are still spending money. People are not yet feeling the pain behind high prices. That's important, because if I'm Powell, I'm worried about inflation, I'm worried about the consumer, but the consumer is still showing signs of spending. Credits are going up, bookings are going up, flights reports are going up. All stock earnings showed that there was a flat expectation, right? I don't think I spelled that correctly, of consumer inflation. That's interesting. Now, if you look at second data, our CPI has been booming lately, right? Consumer confidence went up in the United States. It did. Like, people are like, yeah, okay, cool. That's all good. Cut off the terps and reserves. We've got still a little bit of money to spend. It hasn't dawned. And this happened the same way, 2007, 2009 crisis. There was the most spending that happened before markets crashed, because retail traders, normal consumers, people not even in the markets, don't know these things. They're not watching these videos and going, damn, I should start saving. Damn, I really should start finding good investments to lock up my money, because damn, something better is about to happen. Most people are unaware of that. We saw it all, the same thing happening once again, 2008, 2007, 2009, right? Just before that crash, there was a whole lot of money going. Airbnb earnings reports, like, it was insane. Like, Europe is buzzing, like travels, hotels, even car rental companies are reporting profitable levels pre-COVID times, right? We're back to being even more profitable than we were before COVID happened, right? So again, Powell's like, what's going on, right? Everything that we're scared of, maybe we shouldn't really be scared of it, because really, if we're being honest, most consumers are still, they haven't felt the pinch, right? If you got those extra checks and you put them in 2020 and you invested in the stock market and you cashed out, during the first rate signs, you've got a lot of cash in your hands. You made a little bit of money, right? PMI showed that, entertainment is booming. It sounds stupid, but people are going out to the movies. Guys, during a real recession, you will see, because the recession is coming, you will see, you and your wife will fight about how many cartons of milk to buy, because things are so expensive, right? So there's nothing yet on the ground that shows you that what's going on. Now, the red flag is people always, right? So I'm looking at this from a Powell perspective. This is like, okay, this is good. People are not yet kind of like feeling the pinch, yada, yada, yada. Yes, there's inflation, supply chain problems, but the reality is we see this data all the time. In January, we saw a wage price spiral. People are being paid more. We've seen more people get jobs, more economic activity, right? Now, from this particular lens, this is good news. But remember, it's important to understand it in a very clear way. Now, it's a red flag for most macroeconomists, because people, generally speaking, in 1930s, same story, straight during the war, right, the Great Depression, people always spend money like crazy before a recession, because they don't know it's coming, right? There's zero savings, there's a whole lot of debt building up, and then all of a sudden, when the crisis comes, that credit line is turned off. And I spoke about that in my previous video on Sunday, right? So there was the wage price spiral, remember, which I said is something that markets are going to be paying attention to in this next coming NFP report. Right? If the wage price spiral stops, and you can see there was a decline. There was a decline in wages, right? In March, they literally, I'm not making this up, guys. I'm not making this up. I am not making this up. In March, straight face, like we're little kids. The report came out. Let me show you. There we go. Average earnings per month. They wrote 0.0. I mean, look at this, man. Last year, December, the forecast was 0.3. We got a little bit under. Then in January, at the beginning of the year, wages went up. In February, wages went even higher. And then boom, flat. Right? And now they're like, okay, fine, let's go back to like at least 0.04. All right, but that flat amount, the moment in time in history where they gave us a flat, wage increase, right? A wage increase, right? Technically speaking, that could be used as good news, right? So to say, look, man, it's not a problem anymore. And if it comes out this month, 0.4 or lower, that would reaffirm that the wage spiral crisis is no longer a big thing to look out for, right? So that's 4. And then number 6, lastly, JP Morgan's earnings report also reported similar patterns, more spending in the market, more lending, more credit being given out, which are good news. But for me, generally speaking, everything we would need for a perfect storm. Right, the perfect storm, the formula for a market crisis, market crash, big recession. This is what you need, generally speaking, after the type of 2-3 years we've had in the market. Now, this is good news. Please don't get me wrong, because it can point out, if you just read it as it is, what you will get is it can point out that recession is nowhere close, right? That recession, I think Goldman Sachs says recession hitting a year from now, and other experts has it between a year to 18 months, so a year and 6 months, am I right? 1.5 years, right? So it's not going to happen in 2022. Right, and so if we can push the recession to a distant future, what that means to these guys is, well, then let's get aggressive. That's all. Because remember, I want to tighten my monetary policy by increasing rates. I can't tighten too fast and too aggressive if all these things were bad. If things were so bad, right, I can't just now cut, the lifeline in the economy. But since things are good, doing great, right, all of a sudden, and the recession fear is kind of like far away, then this is a perfect time as the Fed to do what? Let's do this. Just want to quickly clean this up. I don't know who's going to need this stuff. I'm going to write in here, perfect storm. Perfect. Sorry about that. This is like awkward because now you're just watching me do this. Meanwhile, if you have time, just like the video, Right, there we go. Right, so at some point in time, if you're thinking like the Fed, you're like, geez, okay, with all this stuff going on right now, right, might not be an indication of the near future. I better start hiking, and I better get aggressive to catch up, because then the only problem I'm looking at as the Fed on my mandate, employment numbers are doing well, wage spiral seems to be under control. The only thing I have to tackle is that beast called inflation. And so the quicker I hike, the quicker I become more aggressive, the better I am. So when they decided to stop printing money in November last year, like I said, remember we spoke about all this stuff about the printing of all that stuff. We said the Fed has become hawkish, right? We spoke about this many times, hawkish. But now that the roles are being reversed and QE has been fully cut, at least according to their report, we now have to see a dovish phase, a Fed, dovish going down, hawkish going up, and we're talking about risk assets here. And dovish will require the Fed, to really start to view things, in a very specific way. Now, the Fed, sorry, terrible. I apologize. I gotta slow down and hear myself talk sometimes. Right? If you've been in my classes, you'll know, what happens with me sometimes in my mind. I apologize. The Fed said they were dovish from a dovish, right, was in March 2020. This is what being dovish was, printing money. So I want to make sure I'm clear. I want to quickly correct myself now. I was just going crazy there by myself. Right, now the dovish was 2020 period, printing money, QE. Like that was dovish, just fueling the markets with a whole lot of money, pumping, pump. And what did people do with that money? People went to go pump things. They pumped Bitcoin. They pumped stocks, right? You put money in people's hands. They're not even working for it. They're going to go try their luck. Let me go take more risk. And when those risks pay off, right, what are they going to do? They're going to try it again. So there was a dovish Fed that kept printing money, and the dovishness of this Fed ended in December 2021. And then in November of 2021 to that December is when the Fed became more hawkish. Hawkish is, all right, we're going to stop this whole stuff. We're going to start to tighten our monetary policy, right? And we're really going to start to reel this thing in. But remember, it's the same stock market, the very same stock market that went through a state of euphoria, of higher highs, the Nasdaq, Bitcoin, 65,000, going to the moon. That was a state of euphoria, and you needed a dovish Fed to get there. That's my big point. For us to get to those incredible highs, we needed to have the policy in place extremely dovish. In November, they say, okay, we've created inflation. We got to change, my people. Now we have to be hawkish. So we're going to kill the print, right? And please note, they printed more money in the last 2 years than they have in 40 years. There's a lot that needs to be corrected, guys, in this economy, and it's going to affect you in your heart in Rwanda, in Zimbabwe, wherever we are. I'm in Africa, right? So I understand that's the tasteless joke, but I hope you get the point. It's going to affect all corners of the world. Right, globally, euro is hawkish right now, aggressively. Bank of England with the pound, aggressively. Dollar, aggressively. In South Africa just increased the interest rate just about maybe a month ago. Right, everybody is on this hawkish tip right now to almost try and kind of like fix a couple of things. Now, given that November 21, there was a change, we started to feel the hawkishness of the Fed in January the 5th. And if you go to your charts, if you just look at NASDAQ, check January 4th, January 5th, you will start to feel the impact, right? That's when that downhill slope really starts to gain momentum. It starts at the end of the year, last year, but it starts to gain momentum then. And we learned that the Fed is fully committed to being hawkish. They give us dates, they give us timelines, they tell us that this is when the printing will stop in March. They were very much on top of it. Wages at that time were growing at an annualized pace of 9%, right? The wage spiral versus inflation in January, if you go through the data, wages were at 9%. It'll be like he's making this stuff up. Like, just go to FOREX Factory, right? Versus inflation, I was saying about 6.9%-ish. And in my last war room video, I showed you that inflation is now at a whooping 8.9%. So a lot of things have changed. Things have gotten worse, which requires an even sterner hawk, a much more hawkish Fed, right? So we've moved from, and this is my reasoning as to why I believe markets have been falling, my reasoning as to why we might see more pain in the future, if I'm being honest, right? We've moved from inflation is transitory, right, to 0.25 is transitory, in the fact that we're going to do the 2004 model, to the Fed completely changing and saying, look, we might need to go 0.50, which is what I think we're going to get tomorrow, which might push rates up, and we might even get a much more aggressive stance, as the year goes on. Now, when that happens long term, we are going to have to see a little bit more pain in the stock market. Guys, all of this is from a fundamental perspective. If you're still with me, I would like to then quickly run through charts with you. I'm just going to do one chart to make my point clear. But if I am correct about my assessment and diagnosis of the market, then you've got more pain coming. There's nothing in the charts right now that contradicts this analysis. There's nothing in the charts. When I look at NASDAQ and I see people always trying to buy, right? And we can talk about different types of traders. I mean, I don't want this video to be about that. If you're a scalper, you know when to get in and get out, sure. But a lot of people are not. And scalpers don't ever tell you people how many times they lose and how many times they risk the market. So I'm going to look at some scalping buys that happened yesterday. I'm going to show you why some people went silent after that, or what happened to those people potentially before NASDAQ exploded to the upside. And I'm going to show you that you have to know when to take trades, right? Even if you don't understand everything I've said so far in this video, at the very least, you must understand when to take trades. But from what I've said right now, you can expect more pain, a little bit more pain. And you're going to have to be able to assess these levels yourself on the charts. Now, if Fed is tightening policy, this is meant to attack inflation. But when you attack inflation, this, this is important. This is so important. I don't want to skip this. If when you attack inflation, guys, what was the 2008 crisis? It was a housing crisis. It was a crisis about a lot of things, but eventually it was the housing crisis. Now, when you attack inflation, you slowly start to attack housing, right? You see housing prices need to start to stabilize. Well, guys, who owns homes, right? If you're renting, you are under no textbook in economics, in capitalism understanding. If you rent where you stay, a flat, a house, a cottage, it doesn't really matter. If you're renting, you're automatically, generally speaking, excluded from what we call a wealthy class. If you do not own the means of production, a factory, land, blah, 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 and you do not own the means of your social reproductivity, which is a home, a house, you are not most of the time under a wealthy class, because it is the wealthy people that own homes. Wealthy people and banks. Banks own houses. Banks sometimes even own the houses that wealthy people own that are renting to. It's like a weird thing. But when you cut down inflation, you are doing a lot of things when the Fed is being hawkish, but the first place you're going to feel the pain is attack on housing. You start to see housing prices stabilize because it reduces the wealth effect and naturally slows down spending. The Fed isn't trying to slow down our spending when we go to KFC. The real spending that needs to be slowed down here is people in private jets, people who own a whole lot of stuff, people who spend a whole lot of money. Seriously, they need to be the people to feel the pinch first. This will start to drive everything else down, all right? That's his long-term strategy, FOMC strategy. It's a basic macro adjustment process, right? The targeting, remember, the lie in capitalism is there's something called the trickle-down effect, which I don't want to get into in this video, but that's the whole thing behind neoliberal policies. Now, when you start to do this, what the Fed is trying to do, and I'm going to put it in red here, is to kill demand. They are trying to kill demand. When you kill demand, you create a crackdown on assets. What are assets? Yes, you're right. Housing are assets. But do you know what else is an asset, folks? Stocks. Stocks are an asset. Everything that is in the NASDAQ is a stock. Those stocks are assets. A big crackdown in assets means a kill of demand. If NASDAQ buys this week and next week, it wouldn't change what I'm saying. Long-term theses were going down. That's my long-term thesis, right? I can't control the timing, but I'm telling you right now, if the inflation, and we're going to hear what the man says tomorrow, but if everything is as hot as I believe it is, they're going to have to kill demand. A killing of demand is a crackdown in assets. You want to attack the wealthy. I'm going to slow them down a little bit. So you start to crack down on homes, home owners, stocks, crypto, all these assets, because that's when you will start to see a slight net worth decline, which will slow down spending, because these people spend the most. You and me with our $10 do not spend the most. The person who thinks it's reasonable to buy a piece of t-shirt with a brand worth 50,000 US dollars spends the most. So you need to start to slow down this type of spending. Right, now let's look at some charts, man. I really hope you guys enjoyed that level of detail in the market. I really don't want to waste too much of your time. Like I said, you just give me 5 more minutes. And if you've liked this video, please like. If you haven't liked, sorry, if you haven't liked it, please do like. Right, so in front of me, in front of you, in front of us is some charts. And because NASDAQ is a big thing, I'm gonna quickly talk to you about 2 types of traders that we saw in the markets yesterday. Yesterday, I had an emotional moment. I posted on the 365 Facebook page. I didn't even run it by. I just sent it out. I was like, look, man, this is incredible. When I check sentiment, You'll be shocked, surprised at how many retail traders are willing to bet their accounts on this thing going back, to all-time highs and to the moon. This was yesterday, literally yesterday, last night actually. And this is what happened on Nasdaq yesterday, ladies and gentlemen. I'm on the 2-hour chart on Nasdaq, and I really want you to understand a couple of things, especially if you come to my war rooms, because if you come to my war rooms, you will understand how I work. Let's find 4 p.m., 3 p.m. ish, when the stock market is rumored to have opened, right? So let's go to the daily time frame first. I mean, I did this yesterday. I don't want to repeat myself, but folks, here we have a broken demand, right? So if there was any institutional buying that was supposed to take place, this demand was supposed to hold. It did not hold, it broke. If you don't understand why, please take the course. 75% off. Time is moving, but I can't teach. There are a lot of details that I need to get through. I'll do like the longest YouTube marathon teaching our trading strategy, right? But the demand was removed, right? And I explained this to them, and they created a supply at the top, and I explained this to you guys on Sunday, right? Okay, so this is at the back of your mind somewhere. All right, now let's go to the 2-hour time frame yesterday. So yesterday at 3 o'clock, the famous time where people try and buy a couple of things, you can see I would not consider this a valid area to buy from, especially now that we know that markets broke through it, right? Number one. Number two, there's a break of market structure anyways, right? It's all there. But this weird candlestick right here, the green one in there, that's about 3 o'clock yesterday, right? Where a couple of people started buying. Right, and it could be a day trader, it could be a swing trader, it could be a scalper, right? It really doesn't matter. A lot of people believe Nasdaq was going up. I saw a lot of market speculations, people were doing this, doing that, it's going there, it's going there, and that's perfectly fine. As this was happening, right, I tried to kind of like, say, okay, just be careful, do your thing. It's your money, not financial advice. That's the best I can do. And look at what markets did. As soon as they captivated as many people as possible, spiked them all the way up, markets took all of that back, and any stop losses that were here were liquidated. Nobody tells you this. Nobody says, I was in a scalp, I had 20 million positions, or I was in a day trade, or I was opening swing position and I was going up to the moon and I got stopped out. Because that's not, I don't know why people care. You're always going to lose in the markets and win in the markets. You should, hiding your losses it just doesn't make sense. And I'm going to explain why I don't take such trades. One, I don't want to lose money. Number two, I don't like taking trades that are not high probability setup. Number three, I'm a rule-based trader. Then at 8 p.m., 7 p.m., after they found the bottom at 8 p.m., they moved, right? So retail traders, if you look at most brokers' data, retail traders believe in entering the markets day in, day out. So they're like day traders, scalpers, most of them can't swing. Most retail traders really have problems understanding the psychology of holding, right? So by then, most retailers who entered at 3 and were liquidated by 7 had been out of the market. They'd been chowed. And then markets rallied crazy last night, right? So we're going to see that stuff happen again today, and every day it happens. The same thing happens time and time again. Now, in my war rooms, real quick, you'll see me do this. And people used to ask me this question, why? In 2020, in 2019, I haven't received this question in a long time. I wonder if it's because I've become more clearer, or people haven't just thought about it yet. If I'm doing a war room, let's look at Euro USD, and I say, well, Euro USD, look, I still want to sell. There's more pain coming, blah blah blah, and then price is here today in my war rooms. And then I say, because of that, I'm going to wait to sell up there. You'll see me do something like that, right? But you never hear me say, I'm going to buy to get to my sell point, ever. In fact, you hear me come back to you and say, guys, pending orders are still pending. We'll see how it goes. I'm going to wait. This week, I'm not doing currencies. I'm waiting for my setups. Let's look at indices, or this pending order has expired, or I really wanted to sell up here, but markets never got there. Markets kind of like did something like this and then went on. Life is tough. Let's keep it moving. Let's find another asset. Why do I not buy the rallies into my sell position? Because you have to remind yourself, the reason why people do that is the money concept, right? The psychology part. Oh, I can make money going up and I can also make money coming down. Why would I miss out on if I already know that markets are going to come up here to sell? Because for me to sell up here, markets have to get there, right? So why not buy down here and then ride it, make money up and make money down, eat it up and eat it down, right? It's because it never works out the way you think it will. That's why. So let's replay the NASDAQ trade that I just showed you that happened yesterday. Yesterday, a lot of people believed NASDAQ was bullish, right? And so they started buying, right? So the first of all, and what they don't tell you is retail traders in a confirmation candle. Scope. Man, I'm making this video longer than it needs to be, but this is important. If you stuck around to the end, I really hope you get the max out. Let's go to the 1 hour time frame just to see what 3 p.m. looks like. This is 2 o'clock. This is 3 o'clock. That app, the strategy, the scalps, right? This is all they bought. They bought here. They kept buying. Right. So you're opening positions, right? You've seen scalpers. You've seen multiple positions. You've seen day traders, or even one position with the high lot size, and then all of a sudden you stop buying, right? Because now you need to hold for an hour or 2 or 3 for you to make some money. Markets must then pay you, right? So the only way to pay is that these price moves away from these buy positions. Look at the chart. I mean, don't take my word for it. Look at the chart. Immediately an hour after that, there was that big spike that we saw on the 2-hour time frame on the same candlestick that brought you back to zero. The next hour brought you back to negative. The last 2 hours hit your stop loss. That's a guarantee. Markets give and took. And that's why I don't do that kind of stuff. Because just because I've identified a place where I want to sell does not mean markets are going to be so kind to move like this. They're going to shake you off all the time. How much you want to talk about the zigzag flow of market, right? Markets are allowed to do this. And then you get in, and then they do that, take you out, and then they go up. Your psychology is broken. It was a buy, and the next day I was right, it was a buy. So why did they liquidate me? Market manipulation. The broker hates me. They're after me. They want to destroy the retail trader. It's a conspiracy. No, you're a fool. Most of the time we are fools, including me. I don't take these trades no more, but there was a time for 4 years that I kept doing the same mistake over and over again. Markets owe you absolutely nothing. So I only wait for however markets want to distribute all the way down. They come down, come Z, or whatever they want to do. I'm not going to be a part of that. What I will be a part of is a high probability setup that I'm waiting for. That's number one that I want to show you. But the main thing that I want to show you on the charts today is when looking at the NASDAQ, right? On Sunday, I introduced to you guys an ETF, which was Kathy Wood's ETF. I want to introduce another one to you. Look at the QQQ. The QQQ is a NASDAQ tracking ETF. Apologize, just give me 2 seconds. I seem to be struggling. Okay, I see. Sorry. I thought I'd actually lost one of my screens, but it was just me. There we go. Right. I apologize. QQQ. Right. So this is what we're talking about. The QQQ. The QQQ, guys, is a big indicator of the NASDAQ direction. And just so clear, it is literally the ETF, the exchange traded fund that tracks the NASDAQ 100. NASDAQ is at about $13,000 US, or just buy the ETF. The ETF is $300 US. It moves like the NASDAQ. It literally does everything like the NASDAQ does. And to me, it generally provides clarity. There's that broken demand on the NASDAQ. QQQ showed it first that it was going to break, and then there's some interesting levels here. You could get a bit of clarity with a keen hash. You can see there is absolutely nothing different about QQQ and NASDAQ. There's those crazy dates at the top there, November, December last year, where the stock market crisis started. From NASDAQ's all-time high, QQQ started to drop down first. This might be an easier chart to read, all right, in my humble opinion. If NASDAQ and its movements freak you out so much, all right, this might be an easier chart to read. This is what QQQ looks like on the governing time frame, right? You can see where we are right now. We're playing at crucial levels, but you can also see we've got the bearish engulfing pattern. If we see an upward momentum, like I've said to you many times, that is because we have to retest to go to the downside. The same thing is there on NASDAQ, and that's my take. That's my take, folks. I don't see right now, until FOMC tomorrow, Wednesday, says something completely different, I'll change my mind and I'll make a video to update you on my new thoughts. But right now, I'm seeing a little bit more pain. I am seeing a little bit more pain, and I'm seeing a lot of people on the wrong side of these trades. A lot of people still trying to buy Euro USD in the long term, right? You always get good rallies for them to get sold up. You see, this is NASDAQ on the governing time frame. I see the same thing. I was told I was crazy. Maybe it'll stop here, maybe. But this guaranteed possibility. Ladies and gentlemen, my name is Leroy James Mycerian. I'm the head trader of 365 Trading Academy. If you enjoyed this video, please don't forget to like, don't forget to share. Check out our links down below. The course is fantastic. It's amazing. It's 75% off, 50% off on the Walton 3 Years program, also expiring tomorrow. And I'll see you in the next video. Shake my hand, man. I enjoyed making this with you. I hope you've enjoyed watching. Peace.